Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about tariffs and mortgage rates. But first, we're going to talk about single-family versus multifamily delinquencies after that topic blew up on social. Logan, welcome back to the podcast.
It is wonderful to be here, and thank you all for the multifamily delinquency chart that everyone sent to me right away for me to kind of bring that down to reality. That was over the weekend, and people are still even talking about it today that, what was this about? And I've done this for 14 to 15 years. And in the last decade, I used to deal with the Russian trolls. The Russian trolls it was basically an act of war in America, doing all these fake accounts and disinformation campaigns. And a lot of what the anti-central bank movement does is what the Russian trolls used to do. You could combine them, same sentence structure, charts and everything. But this one was so egregious that it went viral. I think the original person who tweeted it out had like 5 million views, and then everyone tweeted it out and everything. But the fact that everyone kind of somewhat knows it's full of, and the fact that I'm willing to challenge any American citizen because you guys don't realize you don't forecast. Quit pretending that you're a data analyst or economist. So in this context, everyone understood, hey, this doesn't look right. And then we came in and wrote an article and brought the single family delinquency on it and all this stuff. And it's so good to see the pushback, because what do we say? Men in this country do not know they're part of a cult. They get manipulated by these YouTube sites and they go down a rabbit hole and they age. And it gets harder to get out of cults when you get older. So I am here 24/7 live. If anyone wants to debate me on this, please.
So even more context, there was a chart that actually Freddie put out, and it has the name on the chart, right? It says multifamily.
It wasn't necessarily released by Freddie Mac. It was done by the Doom Porn Network, and it's the Freddie Mac seriously delinquency data. That the headline of the chart, it says housing, 6 million people are behind on their mortgages, and then they show a multifamily chart.
Oh.
And the visual is to manipulate men. Why? Because men are easy to manipulate. So here it is. They see that. Oh my God, housing 2008. Oh my God, we're all. And this is what happens. So if you're doing a quote unquote 6 million mortgage people, questionable if, on that number. But in any case, you would actually put the homeowners percentage. Oh, wait a second. We can't put the homeowners percentage chart because it doesn't look that bad. Right? So tactical, the Russians used to do this all the time, and now it's Americans. So when it's Americans, it's domestic, and when it's domestic, we got to take care of business, right? And it was so wonderful to see everyone kind of like, what is this nonsense?
Yeah. So for people who are not perpetually online, so Logan is 24/7 online. I'm just one notch below you, Logan. I'm pretty online, but even I don't swim in the same waters, right? So there was this viral post, like you said, it went crazy. And then everybody was sending it to you going, wait a minute, what does this mean? No, I don't think this is right. This can't be right. This isn't what you've been saying. And so it was a great opportunity for you to be like, yeah, you're right. They recognized that there was something off about this. And the whole thing that was off is that they were saying that, multifamily looks terrible, but they were saying that about homeowners. And it just didn't even make sense.
Northerners never forgot the red wedding, and I'm never going to forget this chart. So, it's one thing for these clowns who hide behind fake names and don't even show their faces, whatever, they're cowards, they're frauds. It's disinformation war versus somebody who believes in math, facts, and data. So I've always said the academic society have allowed these people to go untouched, unscathed. Me, I want them in front of a TV camera. This is the United States of America, not some third world country running around with professional grifters doing weak ass charts like this. We want the battle.
I know you do. Okay, well, let's get into the information part of it, right? You talked about the disinformation. What is the delinquencies, whatever you want to get into on homeowners versus those the multifamily, and what does it mean?
So the single family delinquency data is near record lows, right? Because majority of the loans that are being done in the last 14 years were Freddie and Fannie. This wasn't any like portfolio Wall Street loans. So they don't ever show that chart because there's not much going on there. So now they've tagged it on to FHA. So what I've done is I waited 24 hours because this is what I do tactically. I show the FHA delinquencies with VA and then Freddie and Fannie, and there's nothing abnormal about it. There's 51 million loans in America. There's 40% of homes that don't even have a mortgage. You don't see the foreclosure data take off, not because of FHA's holding stuff back. It's just there's so much nested equity out there that if there's people out there that were in stress, 1.5 to 2 million people lose their jobs every single month, and some of them have sold their homes and you never hear about it. When we see stress in our data line, we see it in the new listings data. Right. And that's why, we always highlight Mike Simonson was the one that went to Lehman Brothers and told them, hey, listen, we track this differently. It's wrong. Lehman Brothers was the one. No, we're good. Goldman Sachs took it. We are the data miners of this country. Right. We'll tell you if it happens, but this is not it. Right. And for something like that to go around and it's wonderful for me to watch that people are fighting back now. I know it because I've done this for 14 years. Chicken.
Okay, well, we've talked about the single family data. Let's talk about that apartment data. Are you worried about what you see in the delinquencies there?
Well, what we always talked about is that the rollover of debt for the apartment construction, right? And we highlighted this in our recession model that we need to keep an eye on the apartment label first, because that was actually taking off when single family permits were falling. And now that permits are at lows. When those units get completed, right, we're going to have a lot of loans go under. All right. And banks that are tied to that, if there's any kind of crisis, what I believe, and I've talked about this for 2 years, I think the Federal Reserve is just going to merge a lot of things. But this is not in a consumption-based economy. This is not going to be the variable that destroys anything, right? It's the consumer, right? If consumers spend less, right, there's your problem. If we have less investment, there's your problem. This is a individual credit issue for a lot of people who got into a very, very hot marketplace with very low rates, and then rates have gone up, and now, it's kind of like what we say about Canada. Like Canada has 90-year more loan modifications, because they're tied to short-term debt. So this is the problem with having short-term debt tied into a sector, that if rates shoot up so fast, you get hit out there. So plus the irony is that this thing has been, the bottom base was in 2019, actually. This thing has been rising for years, right? And people go, well, it's 6 months out. No, it's 2025, okay? People were saying this in 2022, 2023, 2024, and now we're 2025. Other variables are more important tied to the economic cycle than this. So there's going to be losses. There are going to be investors who get hit. There's going to be a reduction in value for apartments. There are going to be some apartment deals like crazy coming out. But this is not the single family. This is not Housing 2008. And if you all want some, you know where I'm at.
Well, let's dig into, because we had a lot of news, as always, over the weekend. And then coming up against, is it Independence Day tomorrow? Tariff Day, whatever you want to call it, which is when this podcast will be broadcast. What are we seeing in the 10-year yield and mortgage rates ahead of that?
Okay, so it's Tuesday morning. A lot of the economic data has been coming softer, of course, but the ISM new orders data really tanked. And because that data line tanked, the 10-year yield started to go lower, but the job openings data was okay, wasn't terrible, wasn't great. I wouldn't call it a game changer, but I think the Atlanta GDP now is negative 3.7%. Even after you make the adjustments to trade and gold or whatever, it's still a negative number. Everyone's kind of mindful of what's going to happen today. It's Liberation Day, so we'll see what it is. But you were going into Liberation Day with softer data, even after we make some trade adjustments. The counter to this is being that, well, part of this is weather and everything. In the second quarter, things will bounce back because we have a lower bar. You can make a case for that. But I think in this case, the 10-year yield was at 4.14% at the lows. We've talked about this for 6 weeks. This is a tough level to crack, right? We highlighted in the tracker. We've thrown everything at this thing. The only thing that this 10-year yield level has been able to hold up, the labor data hasn't broken to even get worse. So we have Jobs Friday coming up. We have Liberation Day right now today. We'll see it, I think, at the close of the market. And we'll see how the market reacts to that. But as we could see, things are a little bit more active than what we're used to. So you try to make sense. And remember, focus with data. What is the big variable stuff? And you kind of want to work with that. But we'll get some clarity with the tariff percentage.
Right. That's the big question right now. So, here we are Tuesday, one day before, and we don't know what to expect.
He's going
Sorry,
to do it at 1 o'clock. It's going to be 1 o'clock p.m. Eastern.
Okay. All right. And it's not Independence Day. That's what I called it. What'd you say? It's Liberation Day. Okay. So it's possible like he is at 1 o'clock. He's like, listen, they've already done their job. We've negotiated these great deals. So this and this and this are off. On the other hand, you have it seemed like over the weekend he sort of ramped up what he wanted to do with tariffs, even maybe above what some of his advisors were saying. So it's really hard to tell what's going to happen.
Normally, I would say it's a trade war tap dance because, you don't really get into it. And this is a good conversation to have. 2018 and 19 was different, right? Somebody showed me a video of some guy saying, oh, Trump is purposely doing this because he wants the stock market to crash so they can cut rates, in this. Okay, so what happened in 2018 and 19, it was a very small trade war tactical dance. The growth rate of inflation was falling. Right? We didn't have the Michigan survey indexes go parabolic on the inflation expectations or down. The economy is in a different state right now. The tariffs are much bigger. So it's not the 2018-19. Now, I normally would say he would just do the whatever, call it off, go for a little bit, make a deal, whatever that is, art of the deal, right? That's what Trump does. But the problem with bluffing so much now, since we started, is that you have to eventually do something because everyone's just going to say, hey, and that's the concern about something like that is when you're in a chaotic period in time and you feel like you're forced to do something you don't want. Then I have the Federal Reserve who's kind of doesn't really know what to do with this yet, even though they said we shouldn't raise rates going into a trade war because it'll create a recession. That means their labor data. So the irony is that the 10-year yield has fallen, right? Even though some of the data lines, the prices paid, I know there's a lot of inflation, early data lines that are showing more disinflation than inflation. But in any case, you are more prone to make mistakes in a chaotic time, but you're also more prone to do something if you feel you have something to prove. Right. And that's the concern. Like if it was always a trade war tap dance, then you make some deals, or let's say Trump does this for 1 month and then he makes some deals. But from that point to on, you can do something that you never originally intended to do. That's my concern. And we'll see what it is. We'll see how long it is as well. But as we can see, we kind of ran into this with a different kind of economic backdrop. And now everybody's kind of thinking about it. Businesses are thinking about it. If you look at the manufacturing surveys, they're all thinking about it. And it's going to be a chaotic year, but our job is to try to make sense of it and keep people in line. And we'll see where the purchase, we're doing this early in the morning, so we don't know what the purchase application data is yet. But on the housing side, even though with all these chaotic headlines, it's the first time that purchase application data is positive. Our weekly data are now positive. It's much different than last year. Last year was a very negative tale. Why? Because mortgage rates were heading towards 7.5%. And this time, from the peak of January 14th, the 10-year yield and mortgage rates have been slowly moving lower.
So we're close to being at the lowest point of the year on mortgage rates, correct?
We're close. The 10-year yield is very close. The spreads are on these days where yields really drop down. The spreads really are negatively affected. When the yields go up, they get better. You would need more rate cuts, like to get that next stage lower out there. I know there's a lot of stuff. There's a lot of people talking about, of course, all of you can understand why the White House want lower mortgage rates and lower 10-year yield. Imagine this trade war talk and then 10-year yield is at 5.5 and mortgage rates are at 8%. It's not going to work well, right? Because you don't have wages growing as fast as they used to, and it becomes more problematic. And it's just one of these things where you're dealing with so many fast headline variables that you can get confused. And I get that. And part of the reasons why we wanted the trackers, we wanted everybody to kind of stay on the same page. And so far this year has been good. I mean, I look at housing a little bit different than everyone. I want slower price growth. I want more inventory. I want a more stable housing market. I'm getting this. This is why last year I was happy. And this year I'm even more happy because the forward-looking demand data are getting better without rates getting to my target level to where we see real growth. That's a positive thing going out in the future. If home prices were rising 8 or 10%, negative. If inventory wasn't growing, negative. But here we're starting to get some balance out there. But that's the tracker at housing. We can control that. We have those set variables. The economic side is just kind of all over the place right now.
All over the place. That's a good way to describe it, I think. Everyone's trying to adjust, and really we don't know until he talks about it. So I guess we'll keep this one short, and with the caveat that you will be writing something up if something big happens on mortgage rates. So people should be keeping an eye out for that.
For all of you that are part of the Instagram family, that key technical level has held now a few times with crazy headlines, stocks selling off, weaker economic data. If the labor data starts to get weaker, look for that 10-year yield to go. I know I'm Hodor, I say it wrong, or whatever, but getting that 380 level is in play. That is the low level of the forecast for this year. So we're not that far away from it. So one or two real bad labor reports and you can get a swing out there. And it's just, I don't know. I don't trust men enough in chaotic times. This is why I always say women are more stable and sensible and everything, but men get their, I mean, even for myself, I want to challenge every single person on planet Earth right there. But in this environment, oh man, you're prone to doing something that you might not want to do. And people have to just settle down and then think about something and be a little bit more tactical. So I'm assuming that there's probably a little bit more tactical stuff going on in the background, because you can't be saying, oh, I haven't decided yet, I don't know what to do, So hopefully there's a little bit more conversation on what the short, medium, and long-term game plan. But we could all see why they wanted lower rates from November.
Absolutely.
Because this would have been a much different conversation if the 10-year yield had shot up and yields are up and mortgage rates are up than currently what we're dealing with.
That would be bad. That would be especially bad for our industry. Logan, thank you so much for being on. Love your passion and your heart about these topics. And we will talk again soon.
Talk soon. And just remember, the Northerners never forgot the red wedding. And I am never, ever going to forget that multifamily chart, ever.
I don't know what that reference is, so I'm going to have to
it's
go.
Game of Thrones.
Oh, that's why. So it's not an actual reference in history?
No, there's a scene. I'll have to show you the episode one time.
I was like, I don't remember this. What is this? Okay. All right. Thanks, Logan.